Hey there, investors. Welcome back to Ponzi Scheme Investments, your go-to channel for all things stock market. Today, we have some intriguing updates from Berkshire Hathaway's latest earnings report. This time, Warren Buffett, often dubbed the Oracle of Omaha, is showing signs of being quite bearish on the stock market. We'll dive deep into his recent moves, including his surprising shift towards cash and treasuries, and what it might mean for us as investors. Stick around till the end, though, because we'll reveal a unique insight on why Berkshire's own stock might be one of the safest bets right now. Before we get started, don't forget to subscribe to Ponzi Scheme Investments for more stock market insights and updates. All right, let's break down Berkshire Hathaway's second quarter earnings report. Berkshire Hathaway had a rather mixed second quarter for 2024. They beat revenue expectations by a whopping $3.4 billion and reported continued growth in operating earnings. However, GAAP net earnings declined by about 8.5%, mainly because their stock portfolio gains were less than the previous year. Despite some mixed results, Berkshire's overall performance was strong. They reported $93.6 billion in revenue, up by 1.1%. Operating earnings were $11.6 billion, up 15%. Operating earnings per share were $5.48. GAAP earnings per share were $14.08. The number of Class B equivalent shares was 2.155 billion, down 0.8%. Insurance was the standout segment, with Geico leading the way. Underwriting profits nearly doubled, contributing to a 53% overall growth in insurance profit. This solid performance in insurance helped offset some of the declines in other segments like Burlington Northern Santa Fe and Berkshire Hathaway Energy. One of the most eye-catching aspects of this earnings report was the significant shift in Berkshire's investment strategy. Buffett sold off substantial portions of Berkshire's holdings in Apple and Bank of America. At the end of the second quarter, Berkshire's equity portfolio was valued at $284 billion, while cash, equivalents, and bonds totaled $288 billion. For the first time, Berkshire had more money in cash and bonds than in stocks. Berkshire's cash pile swelled to an unprecedented $277 billion, most of which is in treasuries. This move suggests that Buffett is quite bearish on equities at the moment. The Oracle of Omaha seems to be favoring the safety of treasuries over the volatility of stocks. Now, let's talk about Berkshire's valuation. Some key valuation multiples indicate that while Berkshire is not cheap, it is modestly valued. Calculating based on operating earnings, Berkshire has $42 billion in TTM operating earnings, leading to a 21.93 P/E ratio. This suggests that the stock is reasonably priced but not a bargain. As an insurance company, Berkshire does face operational risks, including natural disasters and disease outbreaks, which can increase insurance claims. However, Berkshire is so diversified and conservatively invested that it remains one of the least risky companies in the market. Its massive cash reserve and defensive investments make it well prepared to handle any economic uncertainties. And now, for the part you've been waiting for. Despite Buffett's shift towards treasuries, he still bought back $345 million worth of Berkshire stock in the second quarter. Although this amount is down 86.7% from the first quarter, it indicates that Buffett still finds some value in Berkshire shares. In conclusion, while Buffett's recent moves show a bearish outlook on the stock market, his continued investment in Berkshire stock suggests that he believes in the long-term strength and stability of his own company. This makes Berkshire Hathaway a compelling choice for risk-averse investors looking for a stable investment in uncertain times. That's all for today, folks. If you found this video insightful, make sure to give it a thumbs up and subscribe to Ponzi Scheme Investments for more updates. See you in the next video.